In this very moment, trillions of dollars in value are represented in global stock markets. Every second, millions of shares change hands, fortunes rise and fall, and the world's economy shifts. From the historic trading floors to the silent hum of server farms, the stock market has evolved from a physical exchange to a vast digital network. Today, anyone with a smartphone can become an investor, joining institutions and algorithms in the never-ending quest for profit. The numbers are staggering. The New York Stock Exchange, one of the world's largest, lists over 2,400 companies, with a combined market capitalization exceeding $30 trillion as of 2024. Each day, hundreds of millions to over a billion shares are traded on this exchange alone. And this is just one market. From Tokyo to London, Frankfurt to Shanghai, a complex web of exchanges operates around the clock, linking economies across the globe. The total global stock market capitalization exceeded $100 trillion in 2023, representing an enormous pool of wealth and economic activity. On any given day, billions of dollars worth of stocks are traded worldwide, with volume fluctuating based on market conditions and global events. But how did we get here? How did a system that began with handwritten ledgers and paper stocks transform into this lightning-fast digital powerhouse? Our journey will take us from the roots of the stock market to its cutting-edge present. The evolution of the global stock market, a story of how we built one of the most complex financial systems in history and how it shapes our world every day. As we enter the 17th century, we witness the birth of what we would recognize as modern stock markets. This era is marked by the rise of joint stock companies, particularly those involved in colonial trade. In 1602, the Dutch East India Company, Verenigde Oostindische Compagnie, or VOC, becomes the world's first publicly traded company. The VOC issues shares and bonds to the general public, allowing investors to directly fund and profit from the company's voyages to Asia. The innovation of the VOC was not just in issuing shares, but in making these shares easily transferable. This liquidity was crucial in attracting investors and creating an active secondary market for shares. The success of the VOC spurs the creation of other joint stock companies across Europe. One such company that adopts this approach is the English East India Company. Founded in 1600, 2 years before the VOC, it had initially operated on a different financial model. However, observing the success of the Dutch approach, the English East India Company decides to follow a similar path. In 1613, 11 years after the VOC's innovation, the English company begins issuing stock to the public. This move by the English East India Company represents a significant shift in its financial structure, allowing it to raise more capital and involve a broader range of investors in its operations. While it comes later than the VOC's public offering, it nonetheless marks an important step in the spread of the joint stock company model across Europe. As trading in company shares becomes more common, the need for a dedicated trading venue becomes apparent. In response to this need, the Amsterdam Stock Exchange is established in 1611. This marks a significant development in financial history, as it becomes the world's first official stock exchange. In its early days, the exchange operates in a relatively informal setting. Traders gather on the New Bridge, Nieuwe Brug, in Amsterdam to conduct their business. This open-air location serves as the central point for buying and selling shares. The bridge buzzes with activity as investors and merchants meet, negotiate, and complete their transactions. This arrangement continues for 2 years, with the New Bridge acting as the heart of Amsterdam's financial activities. However, as the volume of trade grows and the exchange gains importance, the limitations of this open-air setting become increasingly apparent. In 1613, a significant change occurs. The Amsterdam Stock Exchange moves from its original location on the New Bridge to an indoor venue. This new building becomes known as the Amsterdam Beurs, or Amsterdam Exchange Building. The move indoors represents a major step in the evolution of the stock exchange, providing a more structured and protected environment for financial transactions. As the 17th century progresses, the newly established stock markets and financial systems face their first major challenge. In the Dutch Republic between 1636 and 1637, an extraordinary event unfolds that will become known as Tulip Mania. This episode marks the first documented stock market bubble and crash in history. Tulips, originally imported from the Ottoman Empire, have become increasingly popular in Dutch society. Their vibrant colors and rarity make them a coveted status symbol among the elite. As demand for these flowers grows, tulip bulbs gradually transform from simple horticultural items into traded commodities. The market for tulip bulbs begins to heat up slowly at first. Prices rise steadily, attracting more investors and speculators. What starts as a niche market soon captures the imagination of a broader segment of society. People from various walks of life, nobles, merchants, shopkeepers, and even farmers, begin to participate in the tulip trade, many seeing it as an opportunity for quick wealth. By 1636, the tulip market reaches a fever pitch. Bulbs change hands at ever-increasing prices, sometimes being sold multiple times in a single day. The value of certain rare varieties skyrockets to extraordinary levels. At the peak of the mania, some tulip bulbs fetch prices equivalent to luxury houses in Amsterdam's prestigious canal district. Speculation fuels this market to dizzying heights. Many buyers have no intention of planting the bulbs. Instead, they hope to sell them at a profit to the next eager investor. This creates a classic speculative bubble where prices become increasingly detached from the intrinsic value of the asset. However, like all bubbles, this one eventually reaches its breaking point. In February 1637, buyers at a routine bulb auction refused to pay the exorbitant prices. This seemingly small event triggers a panic that spreads rapidly through the market. Almost overnight, the tulip market collapses, leaving many investors facing financial ruin. As the 17th century moves ahead, London emerges as another significant center for financial activity. However, unlike Amsterdam with its formal stock exchange, London's stock trading scene develops in a more organic, informal manner. In the bustling streets of London, coffee houses become popular meeting places for merchants, traders, and other professionals. These establishments offer more than just coffee. They serve as vibrant hubs of information exchange and business dealings. Among these coffee houses, one stands out in particular, Jonathan's Coffee House. Located in Change Alley off Cornhill in the City of London, Jonathan's Coffee House gains prominence in the late 17th century as a favored spot for share trading. The atmosphere inside is lively and often chaotic, with traders huddled around tables, discussing the latest market news and negotiating deals. The popularity of Jonathan's for financial transactions is not accidental. Its location near the Royal Exchange, which mainly deals in goods and commodities, makes it convenient for traders. As the volume of trade grows, a more organized system begins to emerge within Jonathan's. Lists of stock and commodity prices start to be displayed on the walls, providing a rudimentary form of market information. Traders develop their own customs and rules, creating a quasi-formal structure within the informal setting. This arrangement at Jonathan's and other coffee houses serves London's financial community well for several decades. It allows for flexibility and rapid information exchange, crucial in the ever-changing world of stock trading. The coffee house culture also democratizes access to financial markets to some extent, allowing a broader range of individuals to participate in trading activities. However, as the scale and complexity of financial transactions increase, the limitations of this informal system become apparent. The need for a more structured, regulated environment for stock trading gradually becomes evident. This informal arrangement, with its lively atmosphere and rapid exchange of information, serves as the embryonic form of what would eventually evolve into the London Stock Exchange. As the 17th century draws to a close, the financial world takes a significant step towards greater transparency and organization. In 1698, a pivotal development occurs in London that will shape the future of stock trading and market information. John Casting, a pioneering figure in the realm of finance, introduces a groundbreaking publication, The Course of the Exchange and Other Things. This document marks a turning point in the history of financial markets. Casting's publication emerges as a response to the growing need for reliable and consistent information in the increasingly complex world of stock and commodity trading. Until this point, traders had to rely on word of mouth, personal networks, and often unreliable rumors to gauge market prices. The Course of the Exchange and Other Things provides, for the first time, a systematic and regular record of stock and commodity prices. Casting meticulously compiles this information, offering traders a trustworthy source of market data. The publication typically includes prices of stocks, bonds, and key commodities. It also provides exchange rates for various currencies, a crucial resource for merchants involved in international trade. Casting's work represents more than just a list of numbers. It signifies a move towards standardization and professionalization in the financial markets. By providing a common reference point, it helps to level the playing field among traders and investors. The regular publication of this price list contributes to the efficiency of the market. It reduces information asymmetry, allowing for more informed decision-making by a broader range of market participants. As word of Casting's publication spreads, it quickly becomes an indispensable tool for traders and investors in London. Its influence extends beyond the coffee houses and trading floors, reaching merchants, bankers, and even government officials who rely on accurate financial information. This innovation by John Casting lays the foundation for future financial publications and price reporting services. It represents an early step towards the sophisticated market information systems we know today. As the 18th century dawns, the financial world is about to experience two remarkable events that will leave lasting impressions on economic history. In both France and England, a period of intense speculation leads to what we now recognize as classic market bubbles. In France, the Mississippi Company takes center stage. This enterprise, promoted by John Law, a Scottish economist and financier, captures the imagination of the French public. Law, having gained influence over French economic affairs, presents the company as a gateway to the riches of French territories in North America, particularly the Mississippi River region. Across the Channel, England sees the rise of the South Sea Company. This corporation, granted a monopoly on trade with South America, promises vast profits from exotic lands and trade opportunities. Both companies experience a period of extraordinary speculation. Their stock prices begin to climb, slowly at first, then with increasing speed. Investors from all walks of life, enticed by the promise of quick wealth, eagerly purchase shares. The frenzy of buying pushes prices to levels far beyond any rational valuation of the company's assets or potential profits. However, the euphoria is short-lived. In 1720, both bubbles burst spectacularly. The Mississippi Company and the South Sea Company see their stock prices plummet, wiping out the paper wealth of countless investors. The collapse is sudden and devastating, earning these events the names Mississippi Bubble and South Sea Bubble, respectively. The aftermath of these crashes is severe and far-reaching. Many investors find themselves ruined, from wealthy aristocrats to modest shopkeepers. The economic impact ripples through both nations, affecting trade, credit, and overall economic stability. Public confidence in stock markets and financial institutions is severely shaken. The need for greater oversight becomes apparent, leading to new regulations in both France and England. These events serve as a harsh lesson about the dangers of unchecked speculation and the importance of sound financial practices. The Mississippi and South Sea bubbles become cautionary tales, their stories echoing through financial history. They provide valuable lessons about market psychology, the risks of speculative excess, and the need for robust financial regulation. Lessons that remain relevant in the world of finance to this day. As the 18th century progresses, we witness a significant evolution in the world of finance. Stock markets, which began in coffee houses and informal gatherings, start to take on more structured forms. This period marks their growing importance to national economies on both sides of the Atlantic. In London, a pivotal moment arrives in 1773. The city's brokers, recognizing the need for a dedicated space for their transactions, take a bold step. They construct their own building in Sweeting's Alley. This move marks the formal establishment of the London Stock Exchange, transitioning stock trading from the casual atmosphere of coffee houses to a purpose-built financial institution. This development signifies the growing sophistication and scale of financial markets in Britain. Across the Atlantic Ocean, the young United States is laying the foundations for its own financial markets. In 1790, a significant milestone occurs with the first Bank of the United States issuing stock. This creates a liquid market for these shares, introducing many Americans to the concept of stock ownership and trading. It's a crucial step in developing the financial infrastructure of the new nation. 2 years later, on May 17, 1792, another landmark event takes place in New York City. 24 brokers gather under a buttonwood tree on Wall Street to sign what becomes known as the Buttonwood Agreement. This document establishes a set of trading rules and commissions, effectively creating a structured market for buying and selling securities. This agreement sets the foundation for what would eventually become the New York Stock and Exchange Board, the precursor to the modern New York Stock Exchange, NYSE. These developments collectively represent the maturation of stock markets. They transition from informal, ad hoc arrangements to organized institutions with established rules and dedicated spaces. This formalization reflects the increasing importance of stock markets to national economies. They become crucial mechanisms for raising capital, facilitating investment, and driving economic growth. As the 18th century draws to a close, the world stands on the brink of transformative change. The Industrial Revolution, which had been slowly gaining momentum, begins to accelerate, bringing with it unprecedented economic shifts. As we step into the 19th century, stock markets, which had established themselves as important financial institutions in the previous century, find themselves evolving to meet the new demands of this industrializing world. The demands of industrialization, the need for large-scale capital to fund factories, railroads, and other infrastructure, push these markets to evolve and expand. In this context of rapid change, the London Stock Exchange takes a significant step forward. In 1801, just as the new century begins, the exchange receives its first regulated structure. This development marks a natural progression from its formal establishment in Sweeting's Alley in 1773. The move towards regulation provides a more formal framework for trading activities. It represents a response to the increasing complexity of financial transactions and the growing volume of trades. The new regulatory structure helps to standardize trading practices, enhance transparency, and provide greater protection for investors. This formalization of the London Stock Exchange is not merely a bureaucratic change. It reflects the growing importance of the stock market in Britain's industrializing economy. As businesses seek ever larger amounts of capital to fund their expansion, the role of the stock exchange in channeling investment becomes increasingly crucial. The regulated exchange also helps to cement London's position as a leading financial center in an era of rapid economic change. It provides a model for other exchanges around the world, showcasing how a more structured and regulated market can facilitate the flow of capital necessary for industrial growth. It marks the beginning of a new era in which stock markets will become increasingly central to the functioning of industrial economies. As the 19th century progresses, the ripples of financial innovation and formalization that began in London soon reach across the Atlantic. The United States, a young nation experiencing rapid growth and industrialization, recognizes the need for more structured financial markets to support its burgeoning economy. In 1817, a transformative event occurred in New York City. The New York Stock and Exchange Board, the predecessor to what we now know as the New York Stock Exchange, or NYSE, was officially established. This wasn't merely a formality. The creation of the NYSE marked a significant shift in how stocks were traded in America. For the first time, there was a formal constitution governing the exchange. This document laid out clear rules and regulations for trading, bringing a new level of order and professionalism to the financial markets. One of the most important innovations of the NYSE was the establishment of listing requirements. These were specific criteria that companies had to meet if they wanted their stocks to be traded on the exchange. This helped ensure a certain level of quality and reliability in the stocks being offered, providing more confidence to investors. Perhaps even more revolutionary was the introduction of continuous trading during market hours. Prior to this, stock transactions might happen sporadically throughout the day. Now, there was a set period where trading could occur consistently. This allowed for more dynamic price movements and better reflected the real-time value of stocks based on current events and market sentiment. Moving into the 1820s and 1830s, we see another significant development in American finance. This period witnessed a boom in canal and railroad stocks. These weren't just any companies. They represented the cutting edge of American infrastructure and expansion. Canals and railroads were monumental projects that required vast sums of money to complete. They were essential for connecting different parts of the growing nation, facilitating trade, and opening up new areas for settlement and economic development. The stock market provided a crucial mechanism for raising the massive amounts of capital needed for these projects. Investors, both large and small, could buy shares in these companies, essentially betting on the future growth and success of America. This influx of investment helped drive the growth and sophistication of stock markets. As more money flowed into these infrastructure stocks, the markets expanded and evolved to handle the increased activity. Then in 1834, another milestone was reached with the formal organization of the Philadelphia Stock Exchange. While stock trading had been occurring in Philadelphia for some time, this marked the official establishment of the exchange. Interestingly, the Philadelphia Stock Exchange can claim the title of the oldest stock exchange in the United States. Its formal organization in 1834 predates similar official establishments in other cities, including New York. The creation of the Philadelphia Stock Exchange demonstrated that the concept of organized stock markets was spreading beyond New York. It signaled a growing recognition of the importance of these financial institutions in funding American economic growth and providing opportunities for investment. Together, these developments, the formation of the New York Stock Exchange, the boom in infrastructure stocks, and the organization of the Philadelphia Stock Exchange, laid crucial groundwork for the complex, globally influential American financial markets we know today. They represent key steps in the evolution of how America funded its growth, managed financial risk, and created wealth for its citizens. These developments in both London and the United States demonstrate how stock markets are adapting to the demands of industrialization, playing an increasingly central role in financing economic growth and channeling investment. The changes witnessed during this period lay the groundwork for the more complex and interconnected financial markets of the future. As these financial institutions were taking shape and evolving, another technological development was on the horizon that would dramatically change the nature of stock trading. A technological breakthrough occurred that would forever change the landscape of stock trading: the invention of the telegraph. This innovation, seemingly simple by today's standards, had a profound and revolutionary impact on financial markets. Before the telegraph, information traveled only as fast as a horse could gallop or a ship could sail. Stock prices in New York might be days old by the time they reached Chicago or New Orleans. This delay created significant discrepancies in pricing and made it challenging to have a unified national market. The telegraph changed all of that. Suddenly, information could travel at the speed of electricity, crossing vast distances in a matter of minutes rather than days. For the first time in history, stock prices could be transmitted almost instantly between cities. Brokers who were used to operating with delayed information now had access to near real-time data. A significant trade in New York could now impact prices in Philadelphia or Boston within minutes. The telegraph didn't just change the speed of trading, it transformed the very nature of financial markets. It laid the groundwork for the globally interconnected, high-speed trading world we know today. This breakthrough wasn't limited to American shores. From London to Paris, from New York to Hong Kong, the telegraph began to reshape how financial information traveled across continents and oceans. This technological leap forward marked a crucial step in the evolution of stock markets worldwide. It laid the groundwork for the globally interconnected, near-instantaneous trading environment we know today, fundamentally altering how information flowed and how international markets operated. The telegraph didn't just change the speed of trading, it transformed the very nature of global financial markets, paving the way for further innovations and the eventual creation of the complex, sophisticated international financial systems of the modern era. As the telegraph was revolutionizing the speed of information in financial markets, another event was about to send shockwaves through the American economy and its burgeoning stock exchanges. In 1848, gold was discovered at Sutter's Mill in California. By 1849, word had spread across the nation, igniting what we now know as the California Gold Rush. This wasn't just a migration of prospectors to the West Coast. It was an event that would have profound effects on the stock market, particularly in the realm of mining stocks. As news of the gold discovery captivated the nation, investors saw an opportunity. Mining companies began to form, promising to extract wealth from the California hills. These companies needed substantial capital to fund their operations, and they turned to the stock market to raise it. What followed was a speculative boom in mining stocks. Investors, eager to capitalize on the gold fever sweeping the nation, rushed to buy shares in these mining ventures. The established exchanges like the NYSE and the Philadelphia Stock Exchange, which we discussed earlier, saw a flurry of activity around these new mining stocks. The gold rush created demand for mining stocks, and the availability of these stocks on the market allowed more people to participate in the potential wealth of the gold rush without ever leaving their home cities. However, this period also demonstrated the volatile nature of speculative booms. Many of these mining companies were unproven, and some were little more than schemes to capitalize on investor excitement. As a result, while some investors saw great returns, others lost significant sums when companies failed to deliver on their golden promises. The mining stock boom of 1849 and the years that followed served as a powerful example of how external economic events could drive stock market activity. It showed how the stock market could act as a mechanism for funding large-scale economic endeavors, but also how it could amplify both the highs and lows of economic cycles. The latter half of the 19th century marks a significant period in the evolution of stock markets, characterized by their maturation and deepening integration with national economies. In 1867, a pivotal technological advancement occurs with the introduction of the first stock ticker in New York. The stock ticker becomes a crucial tool for investors and brokers, enabling them to make more informed and timely decisions based on up-to-date market data. The Panic of 1873 serves as a stark illustration of the growing interconnectedness between financial markets and the broader economy. This financial crisis is triggered by the failure of J. Cook and Company, a major banking institution of the time. The collapse of this prominent bank sets off a chain reaction, leading to a severe and prolonged economic depression. This event becomes a turning point, highlighting the profound impact that disruptions in the financial sector can have on the overall economic landscape. In 1878, another technological milestone is achieved with the installation of the first telephone on the floor of the New York Stock Exchange. This development further accelerates the speed of communication within the stock market. The introduction of telephone technology on the trading floor allows for even more rapid exchange of information, order placement, and execution of trades, marking another step forward in the modernization of stock market operations. The concluding decades of the 19th century witness a profound metamorphosis in the American economic landscape. This period is marked by the rise of industrial magnates who would later be dubbed robber barons. Prominent figures such as John D. Rockefeller, Andrew Carnegie, and J.P. Morgan ascend to positions of unprecedented economic influence and power. These industrial leaders perceive the stock market as more than a mere platform for trading. They recognize its potential as a formidable instrument for constructing and financing vast corporate empires. Rockefeller's Standard Oil, Carnegie's Steel Enterprises, and Morgan's financial conglomerate all strategically utilize the stock market to amass enormous amounts of capital. This influx of funds fuels their rapid expansion and enables them to consolidate control over entire industries. The ability of these industrialists to harness the power of the stock market allows them to grow their businesses at an unprecedented scale. They employ innovative financial strategies, including the issuance of stocks and bonds, to fund ambitious projects and acquisitions. This period sees the formation of massive trusts and holding companies, reshaping the very structure of American industry and commerce. The stock market thus becomes a critical nexus between these burgeoning industrial empires and the broader economy, facilitating the concentration of wealth and economic power in the hands of a few influential individuals and corporations. The stock market becomes a key battleground for corporate control. These industrialists issue stocks and bonds to fund ambitious mergers and acquisitions, forever changing the face of American business. Their actions ripple through the market, influencing prices and investor sentiment on a scale never before seen. As the century draws to a close, a crucial innovation emerges that will change how we understand market performance. In 1896, Charles Dow introduces the Dow Jones Industrial Average. This index, initially tracking just 12 stocks, provides a new way to measure overall market health at a glance. For the first time, investors have a simple, singular number that captures broader market trends.